when you fund a captive, there's usually the initial capitalization, which is either the minimum amount required by the domicile, which is obviously not pre-tax dollars, that's the capitalization. But the premiums paid into the captive, if it's properly structured, are deductible. Hope that answers the one question I see here. Also, somebody asked if the controlled group rules apply. The controlled group rules apply particularly if you're making certain elections under 1563. So I think that's what your question was. All right, now let's go on to the next one. It's hard keeping track of all these questions at the same time. All right. All right, now I was talking about the trends in the last 25 years. 25 years ago, my background as an attorney, 25 years ago, 30 years ago, I have a client that was sued for unfair competition, and they had a general liability policy that had personal injury coverage, which most of them have. They would have coverage for an unfair competition case. So that client's relatively low premium they pay for their general liability policy, they would have full coverage for all the attorney's fees and the liability for an unfair competition case. Probably 15 years ago, the commercial carriers cut that out of their policies. 28 years ago, if I had a client that was building properties and they were a contractor and they were subbing their work out, and they had a broad form endorsement general liability policy, ISO form, they would get coverage for the defective work of their subcontractors. The carriers have cut those out. Not that long ago, if a client had an employment practice liability policy, an EPLI policy, and they got involved in a wage and hour claim case, they could get that class action wage and hour claim case, they could get that covered by their carrier. I was doing a symposium with Chubb Insurance, which is a very good commercial carrier, and they told me that they will no longer write wage and hour claim coverage in the state of California or on the East Coast, and only limited in other states. The reason being is that the volatility of those types of claims are so great, and the settlements are so big, it's not worth them writing them. In fact, I heard that they now are not even writing EPLI coverage in Los Angeles County and Orange County because of the plaintiffs' lawyers. So these are just three examples of things that have happened that used to be covered, and your regular commercial policies are no longer covered. Of course, then in certain areas you have mold problems. They won't cover mold anymore. They've excluded that. I work a lot with people on the Gulf Coast in Florida when they have horrible wind problems, and they can't get coverage for wind coverage, particularly the first dollars. And here in California, you have earthquake as a problem, and particularly the first 5% of the value of the buildings. Earthquake, also a big problem. Other environmental coverages you can't get. And then on top of that, you have a whole new series of regulatory liabilities that business owners face. Doctors have to be concerned about Medicare audits, that they've been plugging in the wrong Medicare numbers for the last 6 years, rightly or wrongly, and they get audited. They're going to go through great expense and have a huge liability that could end up destroying them. They have no coverage for those types of risks.